Today's lecture is devoted to the portfolio risk and return. The portfolio perspective within the course is a very essential one in modern investing and in modern risk management and in the other spheres as well. Why? Because it involves evaluating individual investments based on their contribution to the overall portfolio's risk and return rather than on isolation. And first of all, let me give you a concrete example. For example, you can imagine that you are an investor who puts all of their money into a single stock they believe is the best. And while that stock might have great potential, for example, this approach may create a very risky portfolio compared to a diversified one. And because of that, modern portfolio theory teaches us something counterintuitive, I would say. What the extra risk of owning just one security and why it isn't rewarded with high expected returns. And in fact, diversification allows us to reduce risk without necessarily sacrificing returns. The next slide. Let's talk how we measure the power of diversification. First of all, we use something called the diversification ratio. And for sure, it's the risk of an equally weighted portfolio divided by the risk of a single randomly chosen security from the portfolio. And as a practical example of this, let's imagine that if the average standard deviation, for example, of return for our stocks is 25, say, percent, but our equally weighted portfolio has a standard deviation, say, of just 18%. So then our diversification ratio is for about 0.7. And this is a very significant reduction instead of 100%. It's just 72% or 70. However, it's crucial to understand that diversification isn't just a magic bullet. Its effectiveness can vary dependently on market conditions. And for example, when markets are calm and performing well, then diversification tends to work best. But, and this is something many investors learned the hard way in, for example, 2008, then during the financial crisis, correlations between assets tend to increase. And this means, in fact, that diversification provides less protection when we need it most in these hard periods of time. So the next slide, let's dive into the portfolio management process a little bit. So it all starts with planning, and you can believe me, this stage is very critical. And it's where we really get known to our client, for example, due to that. We begin by usually analyzing the investor's risk tolerance, the return objectives, time horizon, and the other, for example, unique circumstances. And this isn't just a quick questionnaire. It's usually an in-depth conversation to truly understand their needs and constraints. And the outcome of this analysis is the investment policy statement, or it is called usually IPS. Why? Because this document is the foundation of our relationship with the client. Because it details their investment objectives and their limitations. Secondly, it provides an objective benchmark for performance of the portfolio management, and so on. And here's the key point. IPS isn't set in stone, for sure. because we need to review and to update it at least annually, or whether there might be a significant change in the client situation. For example, life changes and our investment strategy need to change with it, to be changed with it. Once you have our plan, we have to move into the execution phase. And this is where we put our analysis into action. So we start by examining the risk and return characteristics of different asset classes. And there are two main approaches here. One of them is called top-down, and the second is bottom-up analysis. Therefore, in top-down analysis, we look at the big picture. For example, current macroeconomic conditions, just in order to determine which asset classes are most attractive. And the bottom-up analysis, on the other hand, focuses on identifying individual undervalued securities. But our job doesn't end once we've made the investment, because our final step here is a feedback, is ongoing and crucial. And market change, client circumstances may change as well, and our portfolio will drift from its target allocation as asset prices move. And finally, we need to constantly monitor these changes and periodically rebalance the portfolio, and also evaluate our performance against the benchmarks we set in the IPS during the IPS process. Here you can see the table, and this is a visual representation of the risk-return trade-off across major asset classes. It actually uses US data, the data from the US financial markets from 1926 to up to 2008, and it gives us a long-term perspective. For example, if you look at the small cap stocks, so you can see that they had the highest average return of the period, but also the highest risk. And on the other hand, we have T-bills or treasury bills with the lowest return and lowest risk. And all of this overall illustrates a fundamental principle in finance, which says that the high potential returns generally come with a higher risk. So, in other words, there isn't a free lunch in investing. And here's where it gets interesting, actually, because you can notice how the relationship isn't perfectly linear, because some asset classes offer better risk-adjusted returns than others. And this is why asset allocation is so crucial. So let's talk about how we measure risk in the portfolio theory. First of all, and there are two concepts of the risk measurement here. One of them is variance, and another one is standard deviation. Here, as you can see, the variance is a measure of how spread out a set of numbers are from their average value. And in finance, we're looking at the spread of returns usually. So you can see that the formula might look intimidating, but here's what it means in plain language. So we are calculating how much each possible return deviates from the expected return. So, and squaring those deviations to make them all positive, and weighting them by their probability, and then adding them up. And on the other hand, standard deviation is simply the square root of the variance, because we often prefer usually standard deviation because it's in the same units as our returns, and it makes it easier to interpret. And here's why all this matters. First of all, a higher standard deviation means more volatility. and thus more risk. And if two investments, for example, have the same expected return, the one with the lowest standard deviation here is generally considered better. So the next slide. Now let's consider how different assets move in relation to each other. And this is crucial for understanding real portfolio diversification. Uh, 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 First of all, we have, for this matter, we have covariance measures. This is about how much two variables change together. And usually in investing, we're looking at how the returns of two securities move together over time. This is a really critical thing. And here you can see on the left the formula for covariance, which involves taking the product of each security's deviation from its expected return. And then we assume this, all of these products, and then we divide it by the number of observations minus 1, as you can see. But usually covariance has a problem, and it's because it's hard to interpret on its own. And this actually is where the correlation comes in, because correlation on the opposite side is essentially a standardized version of the covariance, and it's much more interpretable. Here on correlation, the correlation ranges from -1 to +1, and the correlation of +1 means the assets move perfectly together. And correlation of minus equal to -1 means they move perfectly opposite. And 0 means there is no linear relationship at all. In fact, this is vital for portfolio construction because assets with lower or negative correlation can help reduce overall portfolio risk. And it's the mathematical basis for why diversification works. So the next slide. Now let's delve into the concept of risk aversion. This is also a fundamental idea in finance that helps explain investor behavior. For example, a risk-averse investor prefers less risk to more risk. And in the circumstances where everything else is being equal. Given two investments, for example, with the same expected return, they will choose the one with lower risk. But here is a crucial point, because being risk-averse doesn't mean avoiding all risk. A risk-averse, for example, investor might still choose a risky portfolio if, for example, they believe the potential return justifies the risk. And on the other flip side, we have a risk-seeking investors who actually prefer more risk, and also risk-neutral investors who are, say, indifferent to the risk levels. And here, understanding the client's risk aversion is really critical in portfolio management, because it helps us, in fact, determine the appropriate level of risk for the client's portfolio. Yes, a question. If returns are the same, who would choose more risk? Yeah, as you can see later, there is an effective frontier of the distribution of the risk return, and there is ineffective frontier as well of the distribution, and we actually do not observe in the risk diversification the ineffective frontier. Yeah, and thank you for your question. So I will show you up this concept later. So now let's look at how we calculate risk and return for a portfolio of risky assets. So this is very interesting indeed. For example, the expected return of portfolio is straightforward. and it's just a weighted average of the expected returns of each asset. And therefore, the weights are the percentage of the portfolio invested in each asset. And here, by calculating the risk of a portfolio, is much more complex than calculating the risk for the individual stock, for example, because it depends on three factors. First, the standard deviation of each asset, then the portfolio weights, and then the most important, the covariance between each pair of assets. And here is the key insight, maybe, because of the covariance, the risk of a portfolio can be less than the weighted average of the individual asset risk, because and this is actually the so-called magic of diversification. And here you can see that the formula for portfolio standard deviation may look complicated, but so it's not. In fact, because it's very it has very good interpretability. And the important thing here to understand is that it actually captures how the assets interact with each other, not just the individual risks. And usually portfolio managers use this formula to construct portfolios that offer the best possible risk-return trade-off to their clients, because it's about finding the right mix of assets that work well together. So another question, maybe. Yeah, if investor seeks higher risk for high expected return, he's not risk-seeking investor, correct? Risk-seeking investor seeks more risk with the same expected return. So there is a relation, as it was said before, between the risk and return, and therefore, in the so-called efficient frontier of the risk-return distribution, the more risk you take, the more return you get. Therefore, the risk-seeking investor, as we say, moves right through the distribution of risk-return. So the more risk, the more return. But if we fix the return, for example, yes, the investor will seek for the less risk always, because he aims to get reach to the efficient frontier of the distribution. Because, for example, if you if you fix the return and simultaneously get the more risk than you can, for example, then you are not on the efficient frontier of the distribution. So it's not efficient. But anyway, we will come up to this concept. Yeah, thank you for your questions. So the next slide, let's dig deeper into the portfolio risk. This is a very special case. We need to understand when the returns of two assets are perfectly correlated, for example. And if the correlation between two assets is +1, the perfect correlation, then the portfolio standard deviation becomes simply the weighted average of the individual asset standard deviations, as you can see here on the slide. And actually, this is the worst case scenario for diversification, because when assets are perfectly correlated, then we can't reduce risk by combining these assets. But there's a good news as well, because in the real world, perfect correlation is very, very rare, almost impossible. Because for any correlation less than +1, we can reduce portfolio risk through diversification. So this is why we're always looking for assets with low or negative correlations, because they are the key to building more efficient portfolios. So here is an efficient frontier. Here is distribution of the risk return. So you can see here on the axis the standard deviation measure of the risk, the horizontal axis. And the vertical axis, you can see the expected return of the portfolio. This is not for the individual stock, this is for the portfolio. And answering your question, so you can see the efficient frontier on the upper side of the distribution. This is where we have the optimal ratios or the optimal relation of the return to risk. And the line on the bottom, which is dotted, is inefficient frontier because, as you said before, as you noticed before, nobody wants to get less return for the same risk, for example, or nobody wants to get more risk for the same return, for example, if it's fixed. And otherwise, nobody wants to get the not optimal relation of the risk to return. Therefore, when optimizing our portfolios of stocks, for example, we seek for the points for the relations of the risk to return just on the efficient frontier here. So, overall, this picture illustrates the modern portfolio theory, and it is usually called a Markowitz efficient frontier because it was named after Harry Markowitz, who won a Nobel Prize for this work. And here, the efficient frontier represents the set of optimal portfolios that offer the highest expected return for a given level of risk. And each point on the efficient frontier here represents a portfolio. As you move up to the curve, both risk and return, expected return increase. And the key insight here is that for any given level of risk, there is one portfolio that offers the highest expected return. And similarly, for any given expected return, there is one portfolio with the lowest risk. And here, portfolios below the curve are considered inefficient, as I said, and we can get a higher return for the same risk or the same return for the lower risk. Answering one of your questions, the risk-seeking investor will be moving to the right through the efficient frontier of the distribution. So, and he will get the higher return with the higher risk. So now let us try to understand the efficient frontier. And let's talk about how we find the optimal portfolio for a specific investor. Actually, this is where we bring in the concept of the utility, because an investor's utility function usually depends on their degree of risk aversion, and we represent this with indifference curves, so-called, and each curve shows combinations of risk and return that the investor views as equally desirable, I would say. And here we have to notice how the indifference curves slope upward, because this reflects risk aversion. Investors require higher expected returns to compensate for taking on more risk. And the steepness of these curves usually reflects the degree of risk aversion, because a more risk-averse investor will have steeper curves, meaning they require a larger increase in the expected return to take on, for example, additional risk. And the optimal portfolio here for an investor is where they or their highest attainable indifference curve touches the efficient frontier, because this point represents usually the best possible risk-return trade-off for the specific investor. Now let's take a break for 5 minutes. Okay, let's get back. So to proceed on the slide. And here you have to notice that if we, for example, add a risk-free asset to our universe of investments, then something interesting happens actually, because the efficient frontier becomes a straight line here, known as capital allocation line. And actually this line, and we can look at this line later. So actually this line represents all possible combinations of the risk-free asset and the optimal portfolio of risky asset. And the equation for this line might look familiar, for example, because it's very similar to the capital asset pricing model, or CAPM, that will be discussed later. So, and here, all investors, according to this concept, all investors, regardless of their risk preferences, will choose some combination of the risk-free asset and this one optimal risky portfolio. And this is known usually as a two-fund separation theory. So the next slide, yeah, here it is. If you dive deeper into the capital allocation line here, as you can see, and let us consider how it relates to the portfolio construction. Here, the capital allocation line represents all possible combinations of the risk-free asset and the optimal portfolio of risky assets, that was said before. And actually, it's a powerful tool that usually helps us understand the risk-return trade-offs available to investors. Here, as you can see, the slope of the line is very strict and particularly important because it represents the additional expected return you can get for each unit of additional risk you can take on. And this is also known as the Sharpe ratio. The slope of the line is equal to the Sharpe ratio. And here you should notice how the line extends beyond the optimal risky portfolio, and because this represents leveraged positions where, for example, an investor borrows at the risk-free rate to invest more in the risky portfolio. Now you can see on the slide the mixture of the capital allocation line and the investor's indifference concept. And this slide will help you to understand how we determine the optimal portfolio for a specific investor. Here, as you can see on the right, each indifference curve, for example, I1, 2, 3, represents a combination of risk and return that provides the same level of satisfaction or utility for the investor. Here, the higher curves, like, for example, I1, they represent higher levels of satisfaction of the investor. And here, the investor's optimal portfolio is at point X on the graph, because here the highest attainable indifference curve, I2, just touches the capital allocation line. So, and this point finally represents the best possible risk-return trade-off for the particular investor, given their risk preferences, for example, and the available investment opportunities. So, let's compare now how different investors with varying levels of risk aversion would choose their optimal portfolios. Let's look at the two sets of indifferent curves on the graph. Here, the steeper curve, for example, IA, represent a more risk-averse investor, while the flatter curve, for example, IB, on the graph represent a less risk-averse investor. So, and you should notice here how the optimal portfolio for the most risk-averse investor A is further to the left of the capital allocation line compared to the less risk-averse investor B, for example. And here, this graph illustrates a key principle. That is, investors who are less risk-averse will typically choose portfolios with greater risk and higher expected returns. So the next slide. Let's explore here how combining risk-free asset with different risky portfolios may affect our investment options. Here, the graph shows three different efficient risky portfolios, for example, X, Y, and M. And each of these portfolios can be combined with the risk-free rate, risk-free asset to create a set of possible portfolios. We can notice here how the line connecting the risk-free asset with the portfolios, say M, offers the best set of risk-return options. And this line is also tangent to, I would say, to the efficient frontier, and it represents the capital market line, or CML. So portfolio M here is very special because it's what we call the market portfolio. Because in theory, it contains all available risky assets in proportion to their market values. That is why it is market portfolio. And here, the capital market line, or CML, represents all efficient portfolios once we introduce a risk-free asset. And here, any rational investor will choose a portfolio somewhere on this line, for sure. And also, investors at point M here have 100% of their funds in the market portfolio. And those are allocated between RF, which is the return of the risk-free asset, and M. And all of the allocations between these points are lending at the risk-free rate and investing at the rate, investing the rest in M yield. And to the right of the M point, investors are borrowing to invest more than 100% in the portfolio M. That is a difference. So let's talk about different types of the risk investors and what issues they face and how they relate to the capital market line. So here we can divide the total risk into two components. First one, the systematic risk and unsystematic risk. And there is a difference, as you can see, because unsystematic risk, which also called diversifiable or specific risk, in fact, it is a risk that can be eliminated through a diversification effect. It's unique usually to individual securities or sectors. And systematic risk here, which is also known as non-diversifiable or general market risk, in fact, it is a risk that remains even in a well-diversified portfolio. And it's usually affected by the broad market factors, for example. And the key issue here is that investors are only compensated for taking on systematic risk because unsystematic risk can be diversified away at no cost. And here we come up to the beta measure of the risk, in addition to the standard deviation. And here, beta is the measure of systematic risk, and it tells us how sensitive an asset or a portfolio is to market movements in general. So let's talk now about the total risk and different components of the total risk. So the total risk equals to the sum of systematic risk and unsystematic risk. And here, systematic risk is measured by beta, and a beta of 1 usually means that the asset moves in line with the market. The higher beta means more risk, and the lower beta means less risk. Here, the well-diversified portfolios have virtually no unsystematic risk at all, because they only face systematic risk. And here, we come up to the capital asset pricing model, or CAPM, which formalizes this relationship, because it states that the expected return on the asset is the risk-free rate plus a risk premium, and this all is based on the asset's beta. So the next slide, now let's explore how we can estimate expected returns using, for example, factor models. Return generation models here usually use various factors to explain and predict asset returns. These factors can be, for example, macroeconomic, like GDP growth, or fundamental, like earnings growth, or even statistical. And here, the model estimates the sensitivity of each asset's return to these special factors. And usually this helps us to understand what's driving returns and how different economic scenarios might affect our portfolio, for example. These class of models are often called multi-factor models, and they often combine macroeconomic and fundamental factors as well, and they usually provide a more nuanced view of risk and return than single factor models. So the market model is a simple one, but very powerful tool in terms of the portfolio management. It's usually a single factor model where the only factor is the return of the market portfolio, and this simplicity actually makes it widely used in practice. The model breaks down into the asset's return and breaks it down into the components. For example, alpha, which means the asset success return, then beta, which is multiplied by the market general return of the market. And this means the asset sensitivity to the market movements. And then the final component is an error term, which is the part of the return not explained by the market movements. And beta here is really important because it measures how much the asset's return changes when the market return changes. So let's dive deeper into the beta ratio on this slide. Beta, as I said before, usually measures the sensitivity of the asset's return, and sensitivity is measured to the changes in the market return. It's it's rather a standardized measure of systematic risk, and beta of 1 means the asset moves in line with the market, and beta greater than 1 means it's more volatile than the market, and the beta less than 1 means that it's less volatile. And overall, we can calculate beta using the formula shown here on the slide. And here it is essential that the covariance here of the asset's return with the market return divided by the variance of the market return. Usually we can use beta in several ways. The first one, to assess the risk of individual securities, then to construct portfolios with the desired risk characteristics, and finally, to evaluate portfolio performance. So the security market line here, or SML, is rather a key concept in the capital asset pricing model, or CAPM, because security market line here shows the relationship between systematic risk, or beta, and expected return for individual securities or portfolios. Here, at equilibrium, all securities should plot on the SML line. If they don't, it suggests they are mispriced. And so we can look here on the three stocks on the graph here, A, B, and C. Here, stock A is above the SML security market line, and this suggests actually that it's undervalued because it offers a higher return than expected for its level of risk. Stock C is stock A, sorry. So no, stock A is below the SML, so it suggests that the it is overvalued because it offers a lower return than expected on its risk. Yeah. And stock B is above the SML because it is undervalued. So it offers a higher return than expected. And stock C is on the line, as you can see. And this suggests that it's fairly valued. So this is the difference. And here the capital asset pricing model is a foundational theory in modern finance because it provides a framework for pricing risky assets. And in general, CAPM model states that the expected return on an asset is a risk-free rate plus a risk premium. And this risk premium is based on the asset's beta and the market risk premium. So as I said before, the formula here is expected return equals to the risk-free rate plus beta ratio multiplied by the expected market return minus free rate return, or risk-free rate. And this model actually has profound implications. For example, it says that only systematic risk is rewarded. For example, investors aren't compensated for taking on diversifiable risk. Then there's a linear relationship between risk, beta, and expected return. And the market portfolio is optimal risk portfolio for all investors. So you can see here the general formula of the CAPM model. It is usually used for the estimation of the required return for a security, for determination if security is fairly priced, and finally, to calculate the cost effective for a company. So let's review the key assumptions underlying the capital asset pricing model. Investors usually aim to maximize their wealth at the end of the planning period, and they usually care about expected return and risk. So investors can borrow and lend unlimited amounts of the risk-free rate. This is one of the assumptions of the model. And next assumption is all investors have the same expectations about returns, variances, and covariances for securities. Then all assets are perfectly diversifiable and liquid, and they can always be traded at the current market price is another assumption. So the assumption here, the next assumption is that there are no transaction costs or taxes. Then investors are price takers, so their actions don't influence market prices. The number of assets is fixed, is another assumption. And it is really crucial to understand all of these assumptions because they will help us appreciate both the power and limitations of the model. But in reality, many of these assumptions don't hold perfectly, actually, because markets aren't fractionless, investors don't all have the same information or expectations, and there are some limits to borrowing as well. Just a second. So the next slide is here. Let's delve deeper into the same. So we have considered the assumptions. Here the market portfolio is really a central concept of the capital asset pricing model because theoretically it includes all risky assets in the market weighted by their market value. And in practice, we often use broad market indices as proxies here. We would say that the market portfolio is important for several reasons. For example, one of them is that it's only a risky portfolio that all investors hold in the CAPM vault. Then it represents the ultimate in diversification because it includes all available assets. And it serves as a benchmark for performance evaluation as well. And here, passive investors who, for example, don't try to beat the market, often aim to replicate the market portfolio through, for example, index funds or ETFs. So now let us consider the arbitrage pricing theory, or APT, which is one of the alternatives to the CAPM model, for example, in terms of pricing assets and understanding the overall risk. Here, the key idea of APT model is that arbitrage opportunities should not persist in efficient markets, because if they did, investors would quickly exploit them, for example, causing prices to adjust. But unlike a CAPM model, which, for example, uses a single factor or the market factor, market risk, APT allows usually for multiple factors that, for example, can affect asset returns. And in fact, these could include things like inflation, interest rates, or economic growth. And this model, or this theory, states that assets with the same factor sensitivities should have the same expected returns, because if they don't, arbitrage opportunities would exist. So here on the slide, you can see the summary of key performance indicators we can use to evaluate investments. So let's break them down. The first one is average arithmetic yield, which measures usually profitability of the stocks or portfolio. It's really simple to calculate, but it doesn't account for compounding. Then goes standard deviation, which measures risk usually and tells us how much returns typically deviate from the average. Then Sharpe ratio, which measures return per unit of total risk. And it is usually widely used to compare risk-adjusted returns across different investments. Then Trainer ratio, which is similar to Sharpe ratio, but it uses better systematic risk instead of standard deviation compared to the Sharpe ratio. Then goes beta coefficient, which measures systematic risk and means how much an asset returns move with the market. And then Jensen's alpha ratio, which measures excess return relative to what CAPM predicts. And so here the positive alpha suggests outperformance of the portfolio management. And the final one is Modigliani coefficient, which is another risk-adjusted performance measure. which is very similar to the Sharpe ratio, but it is expressed in percentage terms. So let's delve deeper into each coefficient and observe each formula of them. So the Sharpe ratio, which was introduced by William Sharpe in 1966, is really one of the most widely used measures of investment performance. And as you can see here in the slide, it calculates the excess return or the risk-free rate per unit of total risk. So, and as you can see, the formula, Sharpe ratio equals to the difference between return of portfolio and risk-free rate divided by the standard deviation of the portfolio returns. So the higher Sharpe ratio indicates better risk-adjusted performance, and it usually tells us how much additional return we are getting for the additional risk we are taking. So the Sharpe ratio, which is more than 1, means high efficiency in portfolio management. Between 1 and 0, it means the risk is higher than the expected excess return, and less than 0, that means the investment is unadvisable as it underperforms the risk-free rate. So this Sharpe ratio is graphically usually represented by the slope of the capital allocation line. And here, the steeper line indicates a higher Sharpe ratio and better risk-adjusted performance. And here, all portfolios on the capital allocation line have usually the same Sharpe ratio. And this is because they are all presented by the combinations of the same risky portfolio and the risk-free rate. And the Sharpe ratio here uses total risk or standard deviation rather than just systematic risk, and which means it accounts for the effects of diversification. Here you can see the measure of M squared, which is the variation of the Sharpe ratio, and it gives the same rankings as the Sharpe ratio, but expressed the results as a percentage return. And because we can, by means of this, we can make it much more easier to interpret. So usually, as I said before, the Sharpe ratio may be used for the different purposes. For example, to compare different portfolios or strategies, to evaluate the effectiveness of active management, and to determine if the additional risk we are taking is being adequately compensated. So the next one is Treynor ratio for investment performance evaluation. As you can see here, it's calculated as the difference of return of portfolio and risk-free rate divided by the beta of portfolio returns. And here you can see that beta of the portfolio is the standard deviation of the portfolio divided by the variance of the market overall. So here, as you understand, the key difference from the Sharpe ratio that it uses beta or systematic risk instead of standard deviation, or which means total risk. So what is an interpretation of the Treynor ratio? If Treynor ratio is more than 0, then it indicates good performance of the portfolio management. Treynor ratio less than 0 indicates poor performance if the portfolios underperforming the risk-free rate. And portfolio managers usually use Treynor ratio when, for example, comparing well-diversified portfolios. And it's particularly useful when the portfolio's unsystematic risk has been diversified away. And we have to assume, using the Treynor ratio, that the portfolio is well diversified, so it doesn't account for unsystematic risk at all. Because for the less diversified portfolio, the Sharpe ratio might be more appropriate in these terms. Then you can see Jensen alpha coefficient, and he was really developed by Michael Jensen in 1968, and it is a measure of the portfolio's excess return relative to its expected return based on CAPM model. So you can see the formula here. Here, RP means average return on investment portfolio. RF, it's risk-free rate. Then RM is average market return, and BP is market risk of the investment portfolio. So if Jensen alpha is greater than 0, then the portfolio outperformed the market on a risk-adjusted basis. If Jensen alpha is less than 0, then it means the portfolio underperformed the market on risk-adjusted basis. And portfolio managers usually use Jensen's alpha for the evaluation of their performance relative to the market performance, because positive alpha suggests that a portfolio manager is adding value through his investment decisions. And now let us compare the Trainer ratio and Jensen's alpha, which are two important risk-adjusted performance measures. First of all, both measures use beta or systematic risk rather than total risk, and this makes them particularly suitable for, say, evaluating well-diversified portfolios. Then the Trainer ratio is a slope measure similar to the Sharpe ratio, and it tells us what is the excess return per unit of systematic risk. Jensen alpha is otherwise an absolute measure expressed as a percentage, and it's usually tells us how much a portfolio over or underperformed relative to its expected return based on CAPM. So, but as portfolio measures, we usually often use these measures together, because the Trainer ratio helps us compare different portfolios, while Jensen's alpha helps us evaluate performance against the market. And here comes Sortino coefficient, which is a variation of the Sharpe ratio, which only considers downside risk. While the Sharpe ratio, for example, uses total volatility of the returns. And this addresses a criticism of the Sharpe ratio, because that it penalizes actually both upside and downside volatility equally, even though investors are typically more concerned about downside risk. But on the other hand, the Sortino ratio is particularly useful for evaluating portfolios with non-normal return distributions, especially those with high upside potential. And portfolio managers may prefer the Sortino ratio when their clients are particularly concerned about downside risk, for example, and when they are evaluating strategies with asymmetric return profiles. And here you can see information ratio, so which is a measure of active management, portfolio management skill. It is calculated as an excess return of the portfolio over its benchmark, divided by the standard deviation of the excess return, or tracking error, in other words. So the high information ratio usually suggests that the manager is adding more value per unit of the additional risk taken. And Information ratio here is particularly useful for evaluating active managers, but it tells us how much excess return the manager is generating for the amount of active risk they are taking. And usually portfolio managers use information ratio for the following purposes, like evaluate their own performance of the portfolio management, compare different active strategies, decide how much active risk to take on the portfolio, for example. And here comes Colmar coefficient. So the Colmar coefficient or Colmar ratio is usually a performance measure that uses maximum drawdown to the capture to the risk. So it's usually calculated that the compound annual growth or CAGR divided by the maximum drawdown of the period. And it is particularly useful for evaluating strategies where large drawdowns are a significant concern, such as, for example, in hedge funds or other alternative investments. And here, the higher Colmar ratio suggests usually better risk-adjusted performance because it has higher returns and or smaller maximum drawdowns. Portfolio managers usually use Colmar ratio in the following cases when evaluating strategies with significant downside risk, comparing investments across different market environments, assessing the performance of absolute return strategies, for example. And finally, we have to remember that Colmar ratio is really sensitive to the time period chosen because it depends on the worst drawdown during this special period of time. And that is why it is important to consider multiple time frames for a comprehensive evaluation of this ratio. So, and the final one, the final ratio we are considering is Modigliani coefficient, which is also known as M2. And this is a risk-adjusted performance measure proposed by Franco Modigliani in 1997. It adjusts the portfolio return to match the market risk level, and which allows actually for a direct comparison of the market return. So as you can see, the formula here is on the bottom left. And here RF is risk-free rate, sigma m is standard deviation of the market returns, and RM is market return in general. So here, the positive value of ratio indicates that the portfolio outperformed the market on a risk-adjusted basis. And portfolio managers usually use this ratio for the following things. So first of all, it's expressed in percentage terms, making it easy to interpret. Then it allows for a direct comparison with the market return. Then finally, it provides a complementary perspective to other risk-adjusted measures. So, and finally, we have to remember that like all the other performance measures, M2 has a few limitations. For example, it assumes that returns are normally distributed and the investors care equally about upside and downside risk, which is not true. So now we have come up to the first question. The question is, how does the Sortino ratio improve upon the Sharpe ratio when evaluating investments with asymmetric return distribution? So let's take a minute to answer this question. Yeah, it's really great because you're quite right. The right answer is 3.